Welcome to this presentation of the Irish Fiscal Advisory Council's Fiscal Assessment Report, Rising Prices and an Uneven Recovery. The key messages of this report are that the economy has continued to grow despite the many challenges. The economy has recovered and, despite downward revisions, is projected to grow in the years ahead. Higher energy and food prices have taken inflation to the highest rates in a generation. SPU 2022 assumes that energy supply will improve and that inflation will return to normal levels in the years ahead. But there are risks of higher inflation, and the downside risks to activity have increased. The SPU forecasts a sharp improvement in the budget balance, from around 3.5% deficit last year to just 0.8% of GNI star this year, and with the budget balance expected to reach around 2.5–3% of GNI by 2025. The measures taken so far to address the cost of living and to support Ukrainian refugees are within the COVID contingencies, so within the amounts that have already been allocated. Taken together, the debt ratio would fall significantly to just under 80% of GNI star by 2025. Now, this is based on the government meeting its new 5% spending rule in levels terms, the amount of spending that was set out for the medium term in last October's budget. This spending rule is providing a useful signal on policy, but it should be reinforced. However, higher inflation creates significant spending pressures. If there were to be full indexation to the inflation that we've seen so far and as anticipated, there would be no room for additional permanent spending measures without some offsetting policy measures relative to the current plans, either in 2022-23 or over the medium term. This means the government will need to make choices between how to address higher inflation and managing other priorities. There is a delicate balancing act for the government in protecting the economy and poorer households while avoiding adding to inflation through second-round effects. A combination of carefully calibrated and targeted supports, wage and welfare increases could help. It would also be helpful to have a coordinated approach both across policies and with social partners to ensure an outcome that is both fair and strikes a reasonable balance. Over the longer term, over-reliance on corporation tax should be gradually unwound. Corporation tax, much of it paid by a very small number of large multinational companies, now accounts for over 20% of Exchequer revenue. This revenue is vulnerable to all sorts of changes and developments in the global environment. A cap on the amount of corporation tax used to fund spending should be introduced, and the over-reliance gradually unwound through contributions to the rainy day fund or by reducing debt. Another issue is that major policy commitments over the medium term need to be properly costed and factored into the government's plans, which isn't currently the case. There is no estimate of the budgetary costs of implementing the Climate Action Plan. The cost of implementing the Exchequer health reforms hasn't been updated since 2017. We don't really know where we are with that. The impact of ageing on the public finances needs to be addressed, and defence spending in Ireland may rise in the years ahead. So let me now go through in a little bit more detail the Council's assessment. Turning first to the economic outlook. To begin with, the SPU only forecast to 2025. That's only 3 years ahead in terms of the forecast horizon. That makes it very difficult to assess the government's projections, both in terms of the economic and the budgetary projections. It's very hard to see the long-term trends, particularly when there's so much happening in the early years with shocks from COVID and the war in the Ukraine. It also undermines the idea of having a medium-term approach to fiscal policy when the forecasts are only a couple of years ahead. And so the Council assesses that the forecast should always be made to 5 years ahead. As you can see from this chart, the government has sometimes done that. It's committed to doing so, but unfortunately we find ourselves looking at a forecast that's really too short to properly assess some of the medium-term trends. On the substance of the forecasts, energy and food prices have increased sharply, as we all know, and that's led to higher inflation. And this chart shows that the forecast, if you see these light blue bars, the yellow bars show energy and food. You can see that's really what's driven up inflation. Of course, inflation was quite high already coming out of the pandemic because some of the basically shifts that we saw there, and of course rents to contribute to that. But this big surge in inflation is really, for the moment at least, very much tied up with a very sharp increase in food and energy prices. These higher import costs will drag on growth. And you can see in the left-hand chart how a lot of forecasters have revised down their forecasts for the volume of modified domestic demand. That's kind of activity in the domestic economy this year. And that's really on the back of these higher energy and food prices. But actually, the Irish economy has been quite resilient in recent years. If you look at the right-hand chart, which shows the level of GNI star in volume terms, you can see the dotted line here is the SBU profile. It's a little bit weaker than the budget time, but not hugely different. But it's much stronger than the kinds of forecasts that we saw in recent years. And it takes us much closer to the trend that would have been on in 2019 before the pandemic. And that basically reflects the fact that Ireland has benefited from favourable trends in digital pharma and finance. It's partly offset some of the bad news that we've seen elsewhere in the economy. And that's, of course, where we have an uneven recovery. So uncertainty is very high, both around inflation and around prices. And there are big downside risks to global activity. And of course, these could affect the Irish economy if they were to come to pass. Now, there are many risks here. COVID could come back. There's Brexit, some of the developments in the multinational sector, risks of a global slowdown. But here I just want to focus on the prices aspect of it. So the first risk around prices is that energy prices could turn out to be higher than anticipated in the SBU. So if you look at the left-hand chart, which is the price of gas that we've seen, so you see the big surge here, but you also see this dotted line, which is what financial markets expect. And they essentially expect the price to come down, not to the level it was before, but to come down quite significantly, basically as supply chains, as energy use, as energy supply responds to the fact that Russia is now out of the market from the European perspective. But of course, it may be that those things don't happen. A lot of things would need to happen for that energy supply situation to improve that much. And so prices could be higher than expected. The second risk is that the pass-through of the prices that we've already seen to other prices, not directly to energy, but to things like transport, or things like goods prices, could be much higher than has been anticipated. So that's another risk to inflation. And the third risk is that inflation could be higher due to what are called second-round effects, so that everyone asks for higher wages, firms put up their prices, and that just generally increases the price level. Now, the Department of Finance isn't really assuming very strong effects in this area. They essentially assume inflation comes back to around 2%. So there is an upside risk here that we could have these stronger second round effects. And how strong they are partly depends on policy. And if you look at this right-hand chart, which shows the level of prices, as you can see in looking at the green line, actually a lot of the increase in energy and food prices and the immediate impact will already have taken place in the first half of this year. Department of Finance then expects prices to still be rising more than usual, but not that dramatically in the second half of the year, and then to come back to something like usual. But of course, there's an upside risk that this profile could be higher. And as a consequence of that, monetary policy may also be tighter, and that may be a reason for weaker global activity. So what does that mean for the budget? Well, according to the SPU, the budget balance is expected to improve significantly, and you can see that on the green line on the left. Would be coming back into budget balance next year, and then to a fairly chunky balance by 2025. And that partly reflects the fact that recent outturns have been better than expected. So if you look since budget time, which is the grey line, we see that it shifts up. And the reason for that improvement, as you can basically see on the right, is that revenues are coming by the light green bars, it's coming in quite strong. There's also the unwinding of some of the temporary supports, and then spending, which is these dark green bars, the tracks in the budget balance, is not increasing all that fast. So actually overall, you get an increase in the budget balance. This is why we move into surplus. And this is all based on the fact that the government is continuing to increase spending in line with its plan set out last October and the 5% spending rule. So that's keeping spending going at a steady pace. Looking at just the temporary measures, which are impacting a lot on 2022, we see on the left hand, this is what was set out in the budget. So there was 7 billion of contingencies set out at the time for COVID. And so some of that was used for COVID in the early part of the year and for other expenditures. That's about 3 billion. The government then allocated a further 1.5 billion, which was money that was originally earmarked for COVID, but wasn't needed, into the cost of living measures. You can see that leaves around 2.5 billion that hasn't really been allocated, contingencies that are still there relative to the existing plans. Now, the government has indicated that that would be used to support Ukrainian refugees. Now, there's a lot of uncertainty about how many will come, how long they'll stay, what their needs will be. It's very hard to know how much will be required or how much it will cost per refugee. If you take the SPU at face value, and you can see in the right-hand bar, there's a kind of figure in there that you can work out from the SPU. That would suggest quite a high cost per refugee. I think that's very much an upper bound. Probably if you look at international experience, it will come out quite a bit lower. So there are quite a lot of margins of adjustment still within the existing contingencies, both in terms of any additional measures the government wanted to take on the cost of living this year, and also in terms of how much support might be needed for Ukrainian refugees. Looking at those cost of living measures, so these are things the government's introduced in reaction to the higher energy and food prices. There was a set of measures introduced in the early part of the year, including, of course, the excise cuts and the electricity credits, but also a range of other measures. And then a few measures have been introduced since the SPU. The total of all those measures will cost around 1.5 billion. So that's what we saw in the previous chart coming out of the contingency. Most of these measures are one-offs. Some are due to expire around budget time, and there are one or two measures that are permanent. So these are mostly temporary measures in response to a temporary shock. Most of them aren't targeted. So most of them, particularly the excise cuts, the electricity credit, go to everyone, really across the board measures. There are very few measures that are targeted, and that I think is quite important in terms of policy. Stepping back over a longer period, so once these temporary measures unwind, we can see that the public finances have actually benefited from several favourable factors. So if we look at this table on the left, it compares 2019, so before the pandemic, with the forecast for 2025, when most of these temporary factors hopefully should have unwound. And what we see is there's really been very strong growth over that period in income tax and corporation tax. So corporation tax would be up 55%, income tax would be up 55% over that period, corporation tax 70%, so that's a very favourable environment for the government. At the same time, interest costs, which you can see a bit lower down in the table, have fallen over that period. And current spending has not grown that fast. It will have expanded by almost a third, but that's obviously much less than taxes have been increased. So that ultimately means that two things happen. First, the budget balance will improve, and that will help to get debt down, which is welcome. But on the other hand, the government is able to increase public investment on a very big scale, both to address climate change and housing. So we've basically had these favourable revenue trends, and through careful management of the current spending, we can have both much more investment, taking it to a very high level, and an improvement in the budget balance. However, this picture is complicated by higher inflation. The chart on the left shows the council standstill exercise, and this is where we look at the costs of maintaining existing public services, welfare rates, public sector pay in relative terms, keeping that at the existing level, but how much additional cash is going to need to be spent to meet that. Now you can see those costs in the years ahead are going to be quite high, and that's going to be pushed higher by the higher inflation that's expected. So you can see that cost would run, including government plans for investment, would run at almost 5 billion euros most years. But it actually, if you try and make up for the unexpected inflation in 2022, you'd be more around 6.5, 7 billion euros just to maintain the same relative real value of those things. And most of that is coming through higher public sector wages, which is the red bars. You can also see that pensions and higher welfare costs are also adding to that amount. At the bottom, there's a dark red part. That's the contribution of ageing, which is of course still going on, and the blue part is government's investment plans. So if you can see, there's quite a high cost related to the government standing still, and the higher inflation is, the higher that cost will be in cash terms. And you can see a sort of concrete example of that on the right. That's the cost of fully indexing social of the job seekers allowance rate, so maintaining its real value. And to maintain that real value and to make up for the unexpected inflation in 2022, you would need quite a high increase in the cash amounts. Now, we're not saying that's the right thing to do, and we're not saying that's what the government will do, but we're just saying that as a benchmark, if you wanted to maintain things the same in real terms, the cash costs associated with that would be quite high. And that means that the government, a challenge for the government, and you can see it going back to the left-hand chart, is that the total amount of its existing plans and this standstill benchmark adjustment would be more than the top line. That's the increase in government spending that the government has planned. So within existing spending plans, there wouldn't quite be enough space, even just to stand still. And that means the government's going to have to make choices about how far it uprates wages and welfare benefit and how much it wants to do on other things. So inflation is going to make these choices much more difficult. On the revenue side, inflation is actually also beneficial. So obviously, if there's more, things cost more, people spend more, the government is going to get more in terms of taxes. If you look at the forecast revisions since last year, there's about 1 to 2% of GNI star that would translate at sort of higher new forecast revisions would essentially translate into an improvement in revenue of that scale. One of the things that's very important in this context is what's called indexation. So the tax bands for income tax are set in cash terms. If there's higher inflation or if wages increase more income is going to be pushed into the higher marginal tax rates. And so there's a real gain to the government there. It's a real increase in taxes, but it's a real increase in revenue as well. As you can, the green bars here show that effect. Now, the higher inflation is, the higher wage growth is, the bigger that number is. So you can see it's going to be running at about $1 billion a year in the years ahead. Now, the government is committed in the programme of government to some indexation. If you put in the amounts that have been allocated for that, which are these orange amounts, you can see the net effect of that would still be that the government would, in a net term, be raising revenue through raising taxes because of these inflation effects, which are becoming more important. Just to say another point on income taxes, which I think is very important, and we saw already in the earlier table, income tax receipts have been boosted quite significantly by growth in high pay and high tax work. So if you look at income taxes last year, the tax receipts grew by 17%. That's more than double the amount of the wage bill. And that basically reflects the fact that a lot of these gains have been to people in high pay, high tax work. So if you look at the left-hand chart, you can see employee hourly wages, and we've divided it into 3 groups. The yellow is for the highest earners and the highest earning sectors, and the green and red bars are for the other sectors. And you can see there's been this big surge basically in hourly wages in the high wage sectors. And you can also see, if you turn to the right-hand chart, firstly, those sectors actually pay, people in those sectors pay more tax. We have a progressive tax system, so they're more high earners tend to pay more tax. You can also see there's been a surge in actually the amount of tax, the average amount of tax coming from those 5 sectors. And if you work through, if you look through what that might mean in terms of the forecast, it may well mean there's a permanent shift in the average effective tax rate and the amount of tax paid in the economy, basically because so many of the gains have been in these high wage, high tax sectors. Both people who are earning, people getting paid more per hour, but they're all paying that a higher marginal tax rate, and also people who come into those sectors are typically coming in at quite a high wage and paying quite a high rate of tax from the beginning. So this is actually a very encouraging story in terms of public finances. If you want to read more about it, there's an analytical note by our economist Kevin Timoney that was published last week that goes into this in a lot more detail. There's still grounds for caution. This is essentially quite encouraging news, but caution is warranted. This is quite a recent development. It may be that we've somehow misread these trends, or perhaps something special happened in 2021 that we haven't been able to account for. And of course, a lot of this money is really coming through the multinational sector as well, so it adds to those kinds of risks. But taken together, because of the improving budget balance, even though these temporary measures in the short run, the debt ratio is now on a steeper downward path. So if we look at the left-hand chart, the gross debt ratio is expected to be a little bit below 80% of GNI star by 2025. It's over 100% today, so this is quite a big improvement. Although interest rates have increased quite significantly on the back of higher inflation, government interest costs are actually projected to fall in the coming years, and that's because the new debt is being issued at a lower rate of interest than the old debt that it's replacing. Of course, over the longer term, higher interest rates do create more pressure, but by then, hopefully, government debt will be somewhat lower. And if you look at what's driving the revisions to the debt ratio since the previous forecasts last autumn, you can see it's really these blue bars, which are the improvement in the budget balance we saw earlier. There's also this effect I've highlighted in yellow, and that's the effect of higher inflation that just mechanically deflates the debt away. In terms of our policy advice and the fiscal stance we discussed, the government faces a delicate balancing act. They need to strike the right balance between protecting the economy and poorer households from this big surge in energy and food prices, while not adding to inflation through higher second-round effects. It's a very tricky balancing act they have to face. What's important to understand is that the negative impact of higher import prices for Ireland cannot be fully offset for everyone. That's just not possible. Energy is more expensive. We don't produce that much of it. And so we have to buy more of it. And so this is a real hit to the economy. And the question is, how is that managed? How do we make the transition to those higher costs? And also, how do we protect those on lower incomes? And I think if you look at this chart on the left that's taken from the report, what's very important to understand is that for lower income households, this is obviously much more of a challenge than it is for other people in the economy. So if you look on the left, this shows the share of consumption spent on different things, with the yellow part being energy and food, between the lowest fifth of households in terms of income and the highest fifth. And you can see in the lower parts of the income distribution, over a third of people's income, or a third of people's consumption is being spent in these areas, while for the richer households, it's only around 20%. And also this is in terms of their shares of consumption. And of course, poorer people tend not to save very much, and they tend not to have accumulated savings in the way that the richer households do. So this is a shock that's really very uneven in the way that it hits poorer households, older households, more rural households, much, much harder than it will some other households. And that's something the government needs to think about very carefully. A carefully packaged, calibrated package of measures, targeted measures, and sort of wage and welfare rate increases in the appropriate way could help to achieve this, but it is a difficult balance to strike. Coordination between different policies and with the social partners could help in this context, as Ireland has experienced in the past with social partnership, could help to strike this balance, which is really about getting the balance right and making sure that it's fair. Now, one thing that's supporting this process is the fiscal rules. So the exceptional circumstances at EU level continue to apply in 22 and 23. So that means there is space to take appropriate temporary measures and run policy in a sensible way. In any case, by 2022, Ireland would actually be fully compliant, even if the rules applied. So there's no particular issue there, that EU rules aren't complicating things. And the government spending rule, which is introduced last October, is actually providing useful signals that choices need to be made between different spending and tax alternatives. And we saw that earlier, that the spending profile based on that 5% rule doesn't create quite enough space to do absolutely everything that the government might want to do. And so that's going to imply choices, and that is the appropriate way to balance between the impact of the higher energy and food prices and to avoid second round effects on inflation. Now, we think that spending rule could actually be reinforced, that the way it's linked to potential output could be improved, the focus could be broadened, both to include all of the government, not just the Exchequer, and also to include revenue, not just spending, which gives you a rounder picture of the public finances. It could be linked more explicitly to a debt target, and it could be placed on a statutory basis, which would both give it more status by putting it in law, but would also require the government to specify some of the key design features a bit more clearly. There's a bit of a discussion in Chapter 4 exactly about what some of those choices might be, but it might be good for the government to articulate them more clearly. One concern the Council has around the fiscal rules is that the government didn't publish departmental expenditure ceilings in a timely way, as it's required to do by law. It has since produced them, but they're just a technical exercise. They don't really give us any insights into how the government plans to meet the 5% target in terms of the way it's going to allocate spending across different departments. So we think it would really reinforce that process, as well as having this 5% rule at the aggregate level, they also said how they plan to allocate the spending at departmental level. Turning to the specific policies for the years ahead, for 2020-23, as we discussed, full indexation of wages and benefits to higher inflation would break the 5% rule. So this is shown in this chart. So the top bar shows the plans in the SPU. The black line at the end shows the total amount allowed under the ceiling. The green line shows that the spending increase they planned for 22. The light green bar, spending increase they plan for 2023. These are all permanent amounts of spending. Now, if we update that below and we factor in this new grey bar, which is the additional costs of uprating for the unexpected inflation in 2022, you see that takes the government over the amount that's allowed under the current spending ceiling. So the government basically faces a choice about how far to adjust wages and welfare rates and these kinds of things, compared to maybe scaling back plans in other areas, such as current spending, capital spending, or making changes on the tax side. So this really shows how this rule is actually a good way of helping the government to achieve this balance. In practice, there's actually been quite a lot of underspend in 2021. So if the government were to lock in that level of underspending, not fully try and catch up with the fact that it didn't increase core spending as much as planned, that would give it an additional margin of flexibility. So there are a number of margins the government may need to use in achieving, in hitting its spending ceiling for 22-23. Further ahead, the government also needs to make choices. So this is the chart we saw earlier that shows the cost of standing still relative to the amount the government's allowed under its spending rule, which are these dots and bars that you see at the top. So maintaining existing services and current plans would barely fit within that 5% limit. So here again, the government is going to need to prioritize between different forms of spending or raise taxes. And as we'll see in a moment, a particular concern is that major policy commitments haven't been budgeted within these limits. So the constraints are actually even tighter because the government actually hasn't factored in everything that it's planning to do. So on the medium term, we have two major concerns. The first continues to be corporation tax. Corporation tax is expected to remain above 20% of Exchequer revenues in the years ahead. We know those taxes are quite volatile. It's very dependent on how a few companies do. It also depends very much on their decisions about where they want to allocate their activities and their taxation globally, all things Ireland doesn't have a lot of control over. And of course, there are various policy changes in the works as well. The council has updated its estimate of how much of corporation tax we think are excess. That's beyond what we can explain with models, beyond what can be explained by historical and international experience. We now think that's probably in a range of 6 to 9 billion euros. That's been revised up from 3 to 6 billion. And that basically reflects what you see on the left-hand chart, which is the level of corporation tax receipts has really surged. And a lot of that increase is basically coming from these sources that might be considered excess, rather than the profits of companies that have a long history and are deeply integrated with the Irish economy and that are making most of their sales here. One other thing, of course, is the impact of policy. So policy changes. The Department of Finance hasn't updated its €2 billion estimate of the impact of the BEPS project, of the BEPS process, the OECD G20 tax reforms. It's a little bit unclear when and how those reforms are going to be implemented, but given how much revenue has increased since they made those estimates, one would expect those numbers probably to be higher today. And they also haven't provided an estimate of how much they expect the planned rate increase to bring in, but that could be quite significant. If we look at what all this means in terms of public finances, on the right-hand side, we have the structural budget balance, the dark bar, so we can see that we're moving into balance in the next couple of years. We've also created a version with the dotted lines, which is what happens if you take out the excess corporation tax receipts by these estimates. And that shows that actually we would still be in deficit by 2025 using this measure. So there's a big wedge between the picture you get from the headline numbers and the picture that you would get if you excluded this excess corporation tax receipts. But we think it would be helpful if the government actually regularly publishes these numbers so people can understand how much impact is really coming from the CT side. So we think that the council assesses that the reliance on corporation tax to fund the spending should be reduced. At a minimum, the reliance on these tax receipts to fund spending should be capped at the current level. That means if it were to increase further, or if the rate were to increase and that would bring in more money, that money shouldn't be spent. And that's the minimum standard. We also think the reliance should gradually be reduced and the excess reduced either by making contributions to the rainy day fund or by reducing debt. And on the left-hand side, you can see two scenarios where we think about how that could be done. The green bars here show how much additional core spending the government is allowed under the 5% spending rule. The green bar shows what would happen if you would unwind the excess over a 10-year period. You see that's quite gradual, but actually from year to year, it wouldn't make a huge amount of difference relative to the plans, but it would over time quite substantially reduce that reliance on excess corporation tax receipts. On the other hand, you can see the path drawn out by the red dots. And that shows what happens if you made the same adjustment over a couple of years. Now that could be quite disruptive because usually government is increasing spending by several billion a year. And that would mean a couple of years where there's essentially be almost no room to increase spending in cash terms. And that would be very difficult for the government to manage. And that's what could happen if there was a really big fall in corporation tax receipts because of some event that was outside our control. And so I think that makes the case for going more for a gradual approach where incrementally we reduce our reliance rather than waiting essentially to fall off a cliff, which could happen one day, and then it'd be much, much more difficult for the government to manage. The second major concern that the Council has over the medium term is around major policy commitments that aren't costed and need to be costed and then factored into the government's plans. And there are really four areas here: climate change, launcher care, aging costs, and defence spending. So climate change costs will have a very significant impact on the public finances. However, there's currently no estimate of the budgetary cost of implementing the climate action plan. Now, we think that actually a lot of the investments that will be required are actually already covered by the National Development Plan. There's a very good paper by John Fitzgerald that we reference here in the report that comes up with some other estimates of how much public investment would be needed, and also has a lot of actually very good analysis of what the impact on the economy might be. Those investment numbers are similar to what we suspect might be built into the NDP. However, there's no allowance in current budgetary plans for any higher current spending that might be associated with climate change costs. And also there may be a very significant loss of revenue, particularly for motor fuels as people switch to electric cars. Now, the relevant revenues are almost 3% of national income, so this is a huge amount of money. And the government really needs to start factoring those plans, those costs into its budgetary plans and thinking about how it's going to address it. The second area is clarity on healthcare costs, particularly the cost of the launcher care reforms. These haven't been updated in 2017. There was an estimate made in 2022 of how much had been spent so far, but obviously that gives us no real idea of how much is going to be spent. More needs to be spent to complete the implementation of those reforms. Some mechanical estimates that we have suggest it might be another $1.5 billion. These are very crude estimates and don't necessarily provide a very good benchmark, but they do show, I think, there's a real question. The government really does need to update these estimates and explain how much it thinks healthcare is going to cost in the years ahead. The third aspect is obviously a long-standing issue. The Council had a long-term sustainability report 2 years ago looking at this more closely, is the ageing population. So on the left-hand side, you can see how the expected life expectancy and the retirement age. The area in between, the pink area, is the expected years of retirement. You can see that this has been rising essentially over the past decade. It's expected to continue to rise. Eventually, if the pension age increases as proposed by the Pensions Commission, this will stabilize. You can see we're still in an environment where people can expect more years of retirement. On the other hand, the other factor that's driving this up is the number of people reaching age 65 is getting much, much bigger. And that basically reflects the demographics when the birth rate was high in Ireland in the past. You can see that if you compare the 2020s with the 2040s, that there's a 50% increase in the number of people reaching retirement age. So these two factors will create a lot of pressure on the public finances, both in the couple of years ahead and over the longer term. Here, the government has yet to respond to the Pensions Commission's recommendations from last October, and action really is needed and a plan about how this is going to be addressed. One thing that has happened is the government has provided additional information on auto-enrollment. That's a scheme that would enroll people automatically into a private sector pension. This is actually welcome, I think, from a public finance perspective, because it would help people to save more for retirement, which I think is good, probably good for them, but also would potentially reduce pressure on the public finances. But there are some upfront fiscal costs, and those don't seem to be reflected in the existing spending plans of the government. The final area where there might be long-term pressures or medium-term pressures is defense spending. A lot of countries are considering raising defense spending in the wake of the Russian war on Ukraine. The report of the Commission on Defence Forces that came out earlier in the year established a range of scenarios for strengthening defence capability. We've drawn those here. As we can see, Ireland has been spending well below typical European norms over the past couple of years. So this is another potential pressure on spending. So let me summarise the key messages. The economy has continued to grow despite the challenges, but the risks are high. SBU 2022 forecasts a sharp improvement in the budget balance, but higher inflation creates significant spending pressures. There's a delicate balance in protecting the economy and poorer households while adding to inflation through second round effects. A combination of carefully calibrated supports and wage increases together with targeted measures could help. Choices will need to be made about how far to address the cost of living pressures and how far the government wants to pursue other policies. Over the medium term, over-reliance on corporation tax needs to be gradually unwound, and major policy commitments need to be properly costed and factored into the government's plans. Thank you very much for listening, and I look forward to your questions.